Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. I'm really excited about sharing this video with you guys today, and the reason is because it's probably one of the most exciting videos I had to put together. The reason I said that is because what we're going to do today is slightly different to what we've been doing. I'm going to give you a hypothetical kind of portfolio, and we're going to try to grow this portfolio to $1 million US. So I'm going to show you two things that we're going to focus on. We're going to focus on dividend payments. We're going to focus on, as well as that, the price appreciation. And we want to see how long it will take us to reach £1 million, or how much we need to invest in to actually reach to £1 million. Now, majority of the companies that I'm focusing on in this portfolio here is dividend paying companies, and not just dividend paying, dividend growers, companies that grow their dividend year after year, because that's something I talk about a lot. And some of you might be thinking, why does he always talk about this? I will show you exactly why today in this video, because I want to see if I'm carry on investing the way I am now with dividend growers, basically growing companies, where I can be maybe in 5, 10, 15 years down the line. And that's exactly what we're going to focus on, inshallah. So stay tuned for this. If you have not actually pressed that like button already, please do so, because it genuinely helps the channel. There's about 40-something% of you guys that watch the videos regularly that are not subscribed to the channel as well. It makes a huge difference. Please like the video, subscribe to the channel, and of course join us in the Patreon account, where it will cost you about 15p per day, which is not a lot if you think about it in the bigger picture. But you get access to the Discord, you get access to all the buys and sells, you get access to all the brothers in the Discord that are sharing really good practices, as well as the Sharia compliant investing ebook, and you got the dividend calendars and all of that stuff. And top of that, you get my portfolio, family portfolio, which I share with the community in here. Right, so let's now get started with the video. So first thing we're going to talk about is the reason why I always talk about dividend growers, okay? And this is an article that I found recently. And it says the dividend growth stocks have basically outperformed in various market environments, which is really true. Dividend growth stocks have provided an attractive combination of earnings and cash flow growth potential, healthy balance sheet, and basically sustainable dividend policies. And this is important. So the fact that a lot of these companies have a healthy balance sheet, they have excellent free cash flow, which they then give us, basically use to pay us some dividends. And when it comes to dividend growing companies, they can also give you some sort of a buffer when there is some sort of a volatile markets and so on. And let me show you one more thing. I can share the article with you guys. Maybe I'll put it on the Patreon. But let me show you this. So this is a graph to show dividend growers, which is this top line here. You've got non-dividend payers, so companies that do not pay any dividends. Payers with no change in dividends, so they just pay it, but they don't actually increase every single year, which is this line here. And dividend cutters, companies that cut the dividends basically after a while and so on. Okay, and look at this. The outperforming ones are dividend growers. They outperform in the markets, okay, since... So you can see here, okay, the basically last months, but you can see they are outperformed to the markets, which is quite nice to see. And there are more articles like this to show that dividend growing companies have basically outperformed the markets, or they help the S&P 500 to actually do well in the long run, especially when there is basically a time of stagnation, for when there's no improvement in terms of price appreciation, and everything basically stays the same. The companies that increase the dividend and pay the dividends are companies that actually help the overall markets to outperform, or even have some sort of a positive returns. So I'm going to use this market beat website to actually do this calculation. Okay, so I'm going to do the first one here, and maybe I'll do two here, and then I'll share, then I'll go to the spreadsheet and show you, because I've copied over all this data for us, just to make it easier. Otherwise it'll be a bit confusing. So the company we're looking at is Home Depot. We're looking at individual stock. We're looking at quarterly dividends distribution frequency, is basically how often we get paid in that dividend. The drip is basically whether we want to reinvest every dividend that we receive or not. Okay, number of shares, let's say we bought 100 shares for this price, which will cost us about £34,285, okay, for the 100 shares. Annual contribution, we're not adding any money to this. We're not touching Home Depot. We're buying one lump sum of this 100 shares and we're going to leave it alone. Dividend tax rate, you could do it, of course, like maybe a little bit here and there, but for now let's assume that dividend tax rate, because it's US based, I have to pay that 15%, so I'm going to leave that alone. Tax exempt, I'm just going to leave this alone. Okay, just pretend that I'm paying this tax. Of course, the initial annual dividend yield is 2.68. That's exactly what it is right now. Now, Home Depot has I think it's 11%. In fact, let me just redo this. No, in fact, I'll just leave it alone. I think it's 11.5%. The basically expected annual dividend increase. Right now, as we speak, it's about 11%. So I put conservative about 7%. Expected annual share price of price appreciation for the next 10 years. I'm expecting about 5% per annum, and I'm going to do this for 10 years. So we invest in 100 shares. This much, we're going to reinvest the dividends. That's the current dividend. We're expecting about 7% growth in terms of dividend, 5% in terms of price appreciation, and we're going to do that for 10 years. Let's see what happens. We end up with, okay, we will end up with over £70,000 in 10 years, 106% up total return, average annual return about 7.5%, annual dividend income of 2.3%, okay, 2,300 total dividend payment over the 10 years, $14,283 and yield on cost, which is about over 6%. Right now is about 2.68. So after 10 years, that will be about 6.16. Okay, so that's where we are, and you can see there's a little bit more information at the bottom if you want to see the breakdown. So year one, this is where we are. Year two, that's where we are, and then it carries on and up to the 70,000, which is basically what you see here. So you got that information on the bottom of the page if you're interested. So let's have a look at another company. Okay, let's look at maybe PG. Let's go in here and get rid of that. Type PG. That's Procter & Gamble. So let's give it space, and then that's it. Select the company, and it updates the dividend yield and so on. So again, a similar thing. We want to reinvest that money. We're going to reduce that to number of shares to 100. We're going to get rid of that. We're not going to annual contribution. We're not going to make any of that. Okay, 100 shares will cost us that much per share, 15%. That's 2.46 is what we pay, what we get right now in terms of dividend yield. This is their dividend yield. So I'm going to be conservative. Maybe let's go with 5%. And then I'll go with 4% total, basically annually price appreciation side of things. And then I'll do 10 years when it comes to that. Let's do the calculation. You can see here our starting point was £16,446, and at the end of 10 years we've got 30,000. We've got 82% total return. We've got average annual return of 6%. So that is basically what you expected to receive every single year, 6%, which is really good. Annual dividend income of $821. Total return after 10 years, $5,640, and yield on cost of 4.65, which is almost double from where we are now. So it's very interesting to see when you look at this, and these are dividend growing companies. So imagine if I did not basically reinvest that. Okay, and I said I don't want to reinvest the dividends, I'm going to take it. Okay, your money is basically reduced to about 60, and this is now $6,000, and here we've now gone down about 40% and so on. So but reinvesting that while you still basically making money and you still don't need that dividends is actually important. So now what I'm going to do is I'm going to share with you guys 15 different companies. We're going to pretend that we bought 100 shares of each one of these companies. Basically similar sort of a thing. So there were some companies, so I tried every single, if the expected annual dividend increase was 10%, I made it about 7%. If this was basically about 3%, 6% or so on, I made it about 3% or so on. So I was very conservative when it comes to that. But everything you're going to see is based on 10 years. So let's have a look at the first company, okay? And the first company is the one that we looked at, is Home Depot. Home Depot, we said we're going to buy 100 shares, and it will cost us $33,423 at the time of basically copying over the information. Ending balance was 71,000. Total return was 113%, and then average annual return of 7%, which is basically the 7%, which is what we expected, and that's basically what you will receive every single year. And dividend that we received for annually was over $3,000, and then after the 10 years we got about 16,250 something. Dividend yield was 2.63 and 67, and yield on cost was 8% after the 10 years, which is absolutely huge. At the end, I'm going to show you how much we have invested, how much we are up at the end, and you will be very surprised. Okay, so after we invested 100 shares of each one of the companies today, I'll show you exactly how much we paid, how much we received in total at the end, and how much we up, and you'll be absolutely shocked. So 16,000, 32,000 in terms of ending balance, total return 99%, average return was about 7%, annual dividend income of $817 5-year $5,652 at the end of the 10 years. 2.5, 4.67 is basically where we ended up with. Next company we looked at is Automatic Data Processing, for $24,000 for the 20 shares that we bought. For the 100 shares that we bought at the end of the 10 years, we basically received we basically up almost basically £50,000, closer to £50,000. Total return in that period of time is 105. Average annual return is 7%. Annual dividend income 1,843. Total return after the 10 years, almost at $10,000. 2.3 was the dividend yield. 6.73 is, again, remember, yield and cost is very important, because that kind of shows us, based on the initial price that we paid, basically it's now giving us a return of 6.73, which is really good. Now, next one is Visa. 26,864 is what we spent on 100 shares. 47,285 is what we got at the end. Total return of 76%, 6% per annum. Annual dividend yield, basically income of $582, and total return in that 10 years from dividend side of it, 3,400, and dividend yield of 0.7, and at the end was almost 2% what we got. Now the next one was Broadcom. Broadcom is one of the great companies out there. We spent $130,000 to buy 10 shares. $248,000 is where we ended up with. 91% up, 7% per annum. Annual dividend of $6,200, and in terms of total 10 years, we've got $35,000 from this company in terms of dividend. 1.57 is where it was in terms of dividend yield. 5.38 is exactly where we ended up with. MasterCard is another one. £45,000 we spent. 77, almost $78,000 we ended up with. 73% up total return. Average annual return of 6%. Annual dividend income of $722. Total dividend payment basically $4,291. 0.58 is what we started with. We ended up with 1.44, which is quite nice. Next one is Cummins. $28,601 basically is what we paid for 100 shares. 56,000 what we end up with, and half. 98% total return. 7% basically in terms of average annual return, which is really good, better than MasterCard, which is funny. Annual dividend income of $1,400, and annual dividend after the 10 years was basically, the total dividend after 10 years was $9,500. Dividend yield of 2.2, and the yield on cost was 4.64. Next one, we're almost there. Hershey is another one. 19,424. 41,000 is basically where we end up with. $112 in terms of percent in terms of total return. Average annual return of 8%. Annual dividend income of 1,500. In the last 10 years, basically, we would have received 990. Imagine that, $9,000. Dividend yield of 2.85 was where we started with. 2.2 and 7.29 is where we ended up with. Next one is MSCI. Again, 47,000 we spent, and after the 10 years we ended up with 77,000. Total return in that period of time was 63% and 5% in terms of average annual return. 3,162 is where we will end up with. 14,000 is what you will get after the 10 years. This was our starting dividend yield, and this is where we ended up with. Right, to speed things up, I'm going to do the next two together. As you can see, Air Product and Chemicals and Texas Instrument, both companies, this is what we paid, this is what we received at the end of the 10 years. That's how much we would be up in total returns, which is absolutely amazing to see. Okay, in terms of average annual returns, in terms of dividends that we received. And look at this, we would have received by over 11,000 after that 10 years, and 7% and 8% in terms of yield on cost, which is absolutely amazing. Next to J&J and Merck, another pharma companies, 15,000, 12,000, we would end up with 43. Look at the difference, 45,000 and 27,000, 82%, 251%, 6% total return. And then dividend is not very similar. Sorry, this one actually get more dividends, and 14,700 is basically what you would end up with in terms of dividend after 10 years. And look at the yield on cost, which is absolutely amazing. Now we're almost there. Next two is KLA and SPGI and S&P Global. As you can see, we spent 67,000 to buy 100 shares. 99,000 is where we would end up with. 47% up, 4% average annual return. $1,559 was what we would have got in terms of dividend. 9,000 total, 2% dividend yield where we started with. That's different. Actually, no, it's the other way around. So we started with 0.8 and we would have ended up 2. So that's slightly different, and exactly the same thing here. So this is the other way around. There you go. So that is basically what where we would have ended up with. Now the most important part. So this is just to kind of give you how much 100 shares will cost us, where will it end up with, how much we're expecting total returns, and then the average, and then so on. So just to kind of show you again where all of that information came from. So for example, if we said Visa, okay, is the stock that we're looking for, just type Visa space, there you go, select Visa. This information slightly changed. Everything we're going to leave as it is. We get rid of that. We're buying 100 shares. This is the price we're paying, taxes and so on. 15% is what they're expecting. So you can put 10%, maybe 5% here, and then 10 years for that. And if you do the calculation, that's what you would get. I think I used a different thing. I'm not sure. There you go, 47. So I must have done, there we go. I must have actually done 10% instead of whatever it was initially, and then 5% here, so the 10%. So that's basically where all that information came from, which is really nice to see. Now the most important thing is, how much would we pay for this entire portfolio, or where would we end up with after the 10 years? And this is it. This is how much we would have invested. Over 540, now let's call it 550,000 is where we would invested. We would have ended up with over $1 million at the end of the 10 years. So almost doubling our money. Annual dividend income, okay, would be over $28,000. But total per annum base, that's what we would expected. And total dividend payment over the 10 years would be $164,000. So if you subtract these basically from each other, as well as adding that, okay, let me see what we would end up with. And this is where we would be up. So 642,913,000 is basically where we would end up with after 10 years. And that includes the dividends and the price appreciation. And this is the reason why I always say to you guys, don't think about what might happen. You know, you shouldn't be investing what happens like basically quarter to quarter or year after year. You should be investing in for a long term. And if you had some of these companies in your portfolio for that period of time, and again, you're looking for high quality businesses that increase their revenue, net income is growing, the in terms of free cash flow is growing every single year. They have a wide economic moat, so they're basically in terms of their demand, their product for their product is actually still there. And of course, sometimes you'll fail, sometimes you will win. But the most important thing is after 10 years, and you're patient enough to actually hold these companies, and they do what they say they basically been doing over the last whatever 10 years, you could potentially make some really serious money. And I've seen this, some people, I know a few people that have now retired on the just paying using their dividends after 1 million. So 28,000, if your basically expenses is 25,000, you can easily retire on this. And this is the most important thing, and this is what I'm trying to understand. I'm still learning, I'm still doing my research and so on, but that's my goal, inshallah, one day to be able to build a portfolio as nice as this one, and hopefully be in this sort of a thing. There's a guy that I know who invested, I think he invested 250,000. He's now got a portfolio of 470 something thousand pounds, and gets a dividend every single year of £1,000. Okay, so I think it's closer to £2,000 or whatever. So it can happen, and it does happen. You just need to be patient, and this is a proof. Okay, of course we're using this website to give us an idea, whatever, but based on even realistic, even some of the companies that was so realistic, with company that have increased their dividend for 15% every single year for the last 5 years, I went with 7% or 6%. Okay, our price appreciation, I only went for 5% per annum. If I said that, for example, I'm expecting, say what we expected from the S&P 500, 7% every single year, okay, you would be way more. Okay, you'll be way more. But you just have to be patient. You just have to buy high quality businesses and really pay like good amount for those companies. Don't overpay. Just buy companies are high quality and just hold them for the long term. And that's what I wanted to share with you guys, and I hope this kind of changes your mindset, because it's starting to change my mindset. It's starting to make me believe this is doable. Okay, I've been doing this now for 3 something years, and as you can see, it's getting there. We're getting there. Over 4 years of building this portfolio. This portfolio started it started May 10th, I think, of basically 2020. Okay, in about 6 days down the line, this will be a basically 4-year-old portfolio. And as you can see here, we're getting there. Okay, it's not a lot, it's not small, but my aim is every single year is to maximize our account, buy high quality businesses, and hold them for the very, very long time, inshallah. If you enjoy this type of content, please join us on the Patreon account, where you get access to a lot of things, like I said, and it will only cost you 15p. If you like the videos, please just press that like button. If you have not joined us in the community, please do that as well, because there's about over 40 something % of you guys that watch the videos regularly but have not subscribed to the channel. So I would really appreciate if you could do that. Have a wonderful, wonderful day. Assalamu Alaikum.